everyone, welcome back to part 2 of this series where we are going to discuss why was India exposed to tariffs and what are the effects of these tariffs on the Indian economy. From 2020 to 2024, the average applied tariff by the US economy was only around 2%. However, during the same period, the average applied tariff by the Indian economy was reduced from 12% to 8%. It is still much higher than what is imposed by the US economy. How are these tariffs calculated? When President Donald Trump announced the reciprocal tariff on the Liberation Day of 2nd April 2025, India was exposed to 26% tariffs. How was this calculated? So reciprocal tariffs are calculated as India's trade surplus with the US divided by India's exports to the US into 0.5. According to official US sources, India exported goods of worth $87.4 billion to the US, but imported $1.8 billion from the US, thus creating a trade surplus for the Indian economy. So, based on the tariff reciprocal trade formula, which comes out as 26.14%, which rounds off to 26% tariffs, as was announced by President Donald Trump on 2nd of April. However, we know that this tariffs was halted for a 90-day period. But will India be affected from these tariffs? Yes, definitely. Because US continues to be our largest trading partner for the 4th consecutive year. Total trade with the US in 2024 was above $130 billion. US accounts for over 18% of India's total goods exports, and these exports make up around 2.2% of India's GDP. IMF had reduced the growth projections from 6.5% to 6.2%. Moody's had reduced the growth projections for India from 6.6% to 6.23%. And World Bank had reduced India's growth rates from 6.7% to 6.3%. Now coming to August 2025. Based on recent events, we have seen that India has not struck a trade deal with the US. Due to this, several reports and analysis has again come out, and it shows that US exports, or rather India's exports to the US, is going to decline by 40 to 60%. GDP growth is expected to decline by 0.2 to 0.4%. GDP as an overall number is going to decline by 1% with the exemptions that we are currently having. If the exemptions are removed, the GDP growth would decline by 1.2%. However, all these estimates are based on recent analysis and would take again certain time to get a concrete evidence. However, the most important factor to consider in this aspect is that many of the labor-intensive sectors in India, for example, textiles, footwear, auto parts, gems and jewelry, will be hurt significantly. These are the sectors that employ a large chunk of Indian population and hence who will be exposed to high tariffs and will have lesser exports going to the US. In the current scenario, pharmaceuticals, smartphones and energy is currently exempted. All this is happening because we have been unable to struck a trade deal with the US. Stay tuned for part 3, where we are going to discuss the reasons why the India-US trade deal have not been negotiated till now and what does it mean for India.